With 1 month left in 2023, it looks like the US economy has escaped recessions this year. But could a recession hit the US economy in 2024 when markets least expect it? Based on current economic data, it would seem unlikely. The most recent GDP numbers show a 5.3% growth quarter on quarter. On the other hand, if we look at unemployment, initial jobless claims have fallen yet again. Finally, we just got the latest PCE numbers, which is the Fed's favorite inflation indicator, coming in at 0.2% month on month. In other words, inflation seems to have abated, the US economy remains strong, and everyone has jobs. Nothing to worry about, right? This seems to be exactly what markets are expecting. As we can see in this chart, the mention of soft landings in financial articles has skyrocketed over the last few months. Funnily enough, this can actually be seen as a contrarian indicator. In previous instances where this indicator peaked was right ahead of the 2001 recession and the 2008 Great Financial Crisis. So with that said, is there a possibility of a recession in 2024? I'm going to be looking at 4 different economic indicators that can give us some clues as to where we're heading in terms of the macro outlook. First up, the Conference Board Leading Economic Indicator. Pretty straightforward, and as the name suggests, what this does is aggregate a bunch of different macro indicators to try and show us where the economy is going. This is a leading indicator because it tries to stay ahead of the current market dynamic. We can see here the latest release of the Conference Board Economic Indicator, and we can see some of the items that are included in it. Financial components include loans and also the S&P 500, while non-financial components include average hourly earnings or manufacturing strength. So, based on the current outlook projected by the leading economic index, it seems like the US could have indeed narrowly escaped a recession. However, it remains to be seen how these will evolve in 2024. Moving on, I wanted to talk about the SAM rule. The SAM recession indicator signals the start of a recession when the rolling 3-month average unemployment rate climbs 0.50% above the lowest point of the unemployment rate in the last 12 months. What does this mean exactly? The SAM rule basically tries to measure the shift in momentum in unemployment. In other words, rather than looking at absolute levels of employment, it's looking at the 3-month rolling average and how it's changing in terms of the lowest. In other words, this indicator is going to be triggered when unemployment begins to rise sharply. Now, the SAM rule indicator uses 0.50 percentage points as a threshold to confirm that we are in a recession. If we look at the previous 2 instances of recession, we can see that we actually officially entered a recession when the SAM indicator was even lower. Back in 2001, the SAM indicator was at around 0.33, and back in 2007 at around 0.4. Zooming into this indicator today, we can see that the SAM indicator is in fact at 0.33, still not at recessionary levels, but steadily climbing. Now, interestingly, if we were to have shorted the market at points where the SAM indicator reached 0.4, one would have avoided quite serious losses back in 2001 and 2008. Of course, this is an arbitrary measure, but it's a good indication of when employment begins to turn, which in turn is a great indication of when a recession could be coming. However, it's important to note that the creator of this indicator, Claudia Sam, has herself noted that this time could be different. As she pointed out in her own Substack, rules are made to be broken. Sure, the unemployment rate has risen to about 3.9%, but it has been below 4% for almost 2 years. Next up, I wanted to talk about an investor favorite, the yield curve inversion. As we can see in the chart, the yield curve inversion has managed to predict the last 4 recessions. In fact, recessions don't happen when the yield curve inverts, but rather a few months later when the yield curve begins to uninvert. So first of all, what does the yield curve have to do with economic strength, and what can we expect as the yield curve begins to uninvert today? First of all, it's important to note that the yield curve begins to invert when long-term rates begin to drop below short-term rates. Now, there are a couple of different ways of measuring the uninversion. Typically, we use the 10-year and the 2-year, or perhaps the 10-year and the 3-month. The chart that I've actually presented has the 10-year versus the 3-month spread. Now, what this is indicating is that long-term yields have fallen below short-term yields. This actually shows a lowering in growth expectations. In other words, lower long-term rates are a signal that the market expects growth to slow. The yield curve begins to uninvert when long-term yields fall below short-term yields, which happens because growth expectations fall. As growth expectations fall, this begins to be priced in the long end of the yield. Later on, as we approach that recession, the Federal Reserve typically starts cutting rates, which can then lead to the uninversion. The uninversion typically happens because the Federal Reserve is already trying to respond to a recession, however late. It's important to note that it isn't exactly the uninverting of the yield curve or the cutting of rates that lead to a recession, but rather the fact that there is going to be a recession that leads us to cutting rates and the yield curve uninverting. However, we have instances, for example, back in 2019, where the Federal Reserve was indeed cutting rates and the stock market rallied. So what can we expect going forward? As has been noted many times in 2023, we've had one of the most inverted yield curves in years. Over the past few months, we've actually seen the yield curve begin to uninvert as long-term rates began to rise. This was actually pretty bearish for stocks, as we have observed a pretty strong negative correlation between interest rates and stocks. Over the last few months, however, we've seen the 10-year reach a top and begin to pull back, which has also accompanied a stock market rally. So what can we expect in 2024? It's still unclear where the long end of the yield will be. I believe we could definitely see a pullback from here, but we could also see this continue to climb. But this isn't necessarily bearish, as it is reflective of stronger growth expectations. What we can say almost for certain is that we will likely see the short end of the curve begin to go lower. The market is already pricing in almost a 50% likelihood of rate cuts in March. I still believe that the yield curve uninversion could lead to a recession. However, until then, we definitely have some wiggle room for stocks to go up before the economy weakens further. Also, this time is a little bit different than in other instances. For the first time in years, we actually have pretty high long-term interest rates, which are actually signaling that growth expectations are pretty positive in the US. On the other hand, I don't expect the Federal Reserve, unless more signs of recession come into play, to actually cut rates aggressively. Rather, I expect them to cut rates to more normal levels, and the market might respond how we saw it respond more in 2019, where it actually cheers these interest rate cuts. Finally, let's look at M2. M2 is a measure of broad money, which includes cash and deposits. M2 can also be seen as a pretty good proxy of the strength of the economy. When banks are making loans and the economy is working well, we normally see deposits increase. In other words, we see M2 increase. On the other hand, when the economy is contracting and banks are using tighter lending standards, we usually see M2 decrease. In this chart over here, we can see the correlation between the SPX and the yearly rate of change of M2. It's interesting to know that back in 2018 and 2020, we actually saw a divergence between stocks and M2, which eventually led to a correction in markets. For example, back in 2018, the year-on-year growth rate of M2 began to decrease as markets continued to rally, but this eventually led to a broader stock market correction. And the same could be said in 2019-2020, right ahead of the COVID crisis. On the other hand, of course, following the COVID crisis, we had massive amounts of stimulus, and we can see this reflected in the growth of M2. And in fact, we can see that markets peaked just as M2 began to peak too. Now, since then, we entered a period of contraction in M2, during which markets actually bottomed back in October of 2022. And since then, we have seen M2 begin to recover. What can we expect going forward? Seeing as we still have pretty strong data coming from the US and central banks around the world are beginning to cut rates, which generally is good for lending and good for M2, we could expect M2 growth to accelerate from here, in my opinion, which would actually be quite bullish for stocks. In conclusion, the indicators laid out above can help us to get an idea of where we're heading in 2024, but neither of us can tell us with absolute certainty what's going to happen. Macro is as much an art as it is a science, and as mentioned before, rules are made to be broken. This time could be different. Just because something happened in the past doesn't mean it's going to happen again. However, here are my 2 cents. The way I see it, the US economy is still very strong. We can see this reflected in today's data and also in the growth expectations that are being priced in through the yield curve. Monetary tightening is probably over. The Fed is likely going to pause and even begin to cut rates in 2024. Historically speaking, this should be pretty good for markets. The only variable that I'm a little bit worried about right now is unemployment. As we said before, the SAM indicator is beginning to inch higher, nearing that key level of around 0.4 to 0.5. Again, I believe a US recession could happen perhaps in the second half of 2024. However, until then, I think we have some pretty strong indicators that stocks could continue to rally as liquidity improves and the economy remains resilient. So, this is my take on the US economy and markets for 2024. Hope you enjoyed the video and don't forget to like and subscribe if you did.